Hello everyone, welcome to this webinar between Share to Buy and HomeReach. I'm Nick Lee from Share to Buy and I'll be hosting today's session alongside two fantastic experts, Mel Toomey, the Director of Sales at HomeReach, and mortgage broker Gemma Parry from Acumen Mortgages. Between them, they'll be taking you through a look at the current property market and explaining how the shared ownership options HomeReach and the exciting new product HomeReach Flex can help you get onto the property ladder. Before I pass over to the speakers, I just wanted to run through a little bit of quick housekeeping. Firstly, our speakers are going to run through their presentations before opening up to a live Q&A at the end of the session. So if you have any questions that you want us to cover at the end of the session, please use the chat tool that's on the right-hand side of the screen. And yeah, we'll try and get through as many of those as we can at the end. It's also worth keeping an eye on the right-hand side of the screen where we'll be putting links through to the HomeReach and HomeReach Flex websites. We'll be sharing some brochures and some guides and also some contact details for Gemma's company as well. Today's session will also be recorded, so if you have to leave at any point or you lose your connection, then we will be sending out a recording after the session as well. So that is everything from me. So I will now hand over firstly to Gemma and I will see everybody again at the end of the presentation. Thank you very much. Over to you, Gemma. Thanks.
Thank you very much. Good morning, everybody. Hope you're all well, or good afternoon, I should say, shouldn't I really, 3 minutes in. So I'm Gemma Parry. I'm from Acumen Mortgages, and I just want to talk you through a little bit about what's going on in the housing market at the moment. So let's go straight into it. So the housing market, what is going on? So inflation has been all over the news at the moment. That's obviously a really, really big thing. And how does that link to the housing market? So inflation is currently at 6.8%. Now that is higher than we would like it to be. We're aiming for around 2%. However, it is dropping. It was around 8% last time we did these figures. And we were checking, obviously it dropped yesterday to 6.8%. In terms of how that impacts mortgages, I'm going to go into a little bit more detail on the next slide. But basically, the more expensive things are, the more they cost. That means that lenders have to factor that in, and it can sometimes reduce your affordability. Another big thing that's going on with the housing market really is actually the media. So it's not as bad as it seems. However, I don't think in 15 years of doing this job, mortgages have ever been in the newspapers as much as they are at the moment. And that's really impacting consumer confidence. When we see doom and gloom headlines, it makes everybody really worried. And that's something we're seeing at the moment. Another thing that we're talking about a lot at the moment is house prices. And we're hearing a lot about house price crashes and it's going to be 2008 all over again. Actually, realistically, the worst case scenario from the lenders is that house prices will drop about another 3%. So that means that if you were going to buy now, for example, your house might go down slightly, but in reality, what that means is your house is only worth something when you come to sell it. So if you live in your house for the next 10 years, actually your house may well make money. So it's only a loss if you're going to sell at that particular time. In terms of what that means for people trying to buy at the moment, it means that buyers can get a deal. It means that we're trying to sell. There's a bit of a slowdown. Obviously, people are trying to buy houses, and you might maybe be able to get some more incentives than you would have been able to get before off a builder, or maybe you'll get a little bit of a deal if you're buying a second-hand property. But ultimately, there's not going to be a crash simply because supply and demand is still a massive issue. We still have a housing shortage, and we still need to get that sorted. Okay, so just moving on to the mortgage market and what's happening. I mentioned before about the Office of National Statistics. Now, this is really, really important because this is what is affecting affordability. So some people are able to borrow a little bit less at the moment than they have been historically able to borrow. And that's because lenders, as responsible lenders, have to now sit there and say, okay, so the cost of bread and fuel and everything else has increased. And therefore, they have to make sure you can still afford your mortgage, as they've got to tighten the affordability a little bit. However, lenders are still competing for business. Lenders have an awful lot of money still to lend. It's not 2008. I've said that before, but I'll keep repeating it throughout this because they need to lend that money. They have it and they want to lend it. That's why we're still seeing them competing, and we're still seeing them reduce rates. So this week alone, rates are still reducing, and they did last week as well. And they're all assessing cases differently. So what that means for you is it means that, say, for example, if you do a lot of shift work or a lot of overtime, some lenders won't consider that income, but some of them will. It also means that, for example, if you have some debt in the background, but you're going to pay that off before you buy your house, some lenders will consider that debt and some will ignore it. So they are still open for business and they have still got the money to lend. I also just wanted to make a little point about interest rates. So you can see this graph on the screen here. So this shows you from 2000 where interest rates were. And then also we had the crash in 2008 and rates did drop. And you can see where COVID was. And you can see that rates have risen. But rates are still not where they have been historically. So they are high, but really it's a short-term view and they're not as high as they have been. I'm not going to sit here and talk to you about my parents' interest rates or your grandparents or your aunties or your uncles or maybe your first interest rate. But in the 90s, they were around sort of 15, 18%. So they're really not as bad as the media is making them out to be. And that's really important to remember. Okay, so we've just talked about the media and I'm just going to point out some of the headlines. So obviously we had this in The Guardian. UK 2-year fixed rates hit highest level since 2008 and Sky reporting that the average interest rate is over 6%. Now, technically what Sky was saying is true. However, it's not actually true. So in the UK mortgage market, we have hundreds and hundreds of banks and building societies lending money. And the top lenders will have interest rates and the very bottom lenders will have much, much higher interest rates. And they're the lenders that lend to people who may be currently bankrupt or have just come out of CCJs and that kind of stuff. So they're what we call adverse specialist lenders. And their interest rates, because of the risk they're taking, are significantly higher than your Halifaxes, your Nationwide, your TSBs. So actually, when they're saying that the average interest rate is over 6%, they're looking at every single lender in the market and maybe not actually at the mortgages that most of you are going to be able to get, which is your more mainstream lenders. And they haven't really gone above 6% massively since this all started. So currently the lowest 2-year fix is at 5.82%. Just to give you some idea, last year it was at 3.45. So it wasn't at the ones or the twos that we saw during COVID. It was nearly 4% then anyway. And the lowest 5-year fix available at the moment is 5.16. Okay, and just to give you a little bit of an idea, the highest interest rate available today is at 10.9%, but 12 months ago, that highest interest rate was at 7.11. So although they have gone up, it's maybe not quite as dramatic as we're being told it is. Okay, so let's talk about shared ownership. What is it? Shared ownership is where you buy a percentage of the house. So if you can't afford to buy the whole house, you could buy 50% of it, 20% of it, 75% of it, and you can then rent the rest of the property. As your situation changes, so maybe you get a pay rise at work, maybe children grow up and they leave home, as your affordability increases, you can actually then buy more of the property. So you can staircase up and you could go from only 50% to 55% to 60% and so on and so forth until you owned the whole property if that's what you wanted to do. In terms of a deposit, now this does depend on the different shared ownership providers. However, with some of them, you will need 0 deposit. They'll allow you to buy it just based on your income. And with some of them, you will need 5% deposit. Okay. There are lots and lots of lenders doing it. Help to Buy ended, obviously, last year. And since then, shared ownership has really stepped up and become more and more popular. And as a result of that, there's more and more banks and building societies coming in and entering the market and being available on shared ownership. One of the things you do need to be aware of, though, is you do just need to factor in the rent and the charges. So what you might be able to borrow on a standard purchase, you will have to factor in that maybe you'll need to be able to borrow slightly less on this. Okay. In terms of timescales, it's exactly the same as a normal mortgage. So your advisor, your mortgage advisor that you use, they will always try and get you an offer out within the first 4 to 6 weeks of you having an offer on a house accepted. They'll try and get you a mortgage offer. And the timescales are exactly the same with shared ownership. There's no specialist requirements or anything like that. In terms of houses, I get asked this quite a lot. If we buy a shared ownership house, do we all get put on one street? Are we segregated away? Absolutely not. If you buy in a new build estate, it's exactly the same as all the other house types. It's going to be exactly the same. You'll be with people who bought their houses in all sorts of different ways. And unless you tell them, nobody's ever going to know that your house is shared ownership unless you want them to know. Okay. So just moving on to talk about why buy a new build. So even if you're not buying new build off plan, some of the houses you'll be buying will be more modern. And it's really important to talk about why. So on average at the moment in the UK, you're going to be saving around £3,600 on energy bills alone. We all know energy costs have gone up, and because of the technology that the builders are using, extra insulation, extra double glazing, more efficient roofs and energy heaters and things like that, it's really, really energy efficient for you to do that. You're also going to be greener. So the houses are just generally more environmentally friendly, the way they're built. It actually came out today that the average new build house versus buying your average older property saves 2.2 tons of carbon emissions a year just by buying a newer house. So that's something we can all get on board with. And you're also potentially going to benefit from better mortgage deals. So lenders are really keen on people buying greener houses. So if you buy a new build, with some lenders, you may be able to borrow a little bit more money. With some of them, they might give you a slightly lower interest rate. And with some of them, they'll give you some money back for doing something nice. Also, the houses will come with warranties. So most new builds in the UK are under a scheme called the NHBC scheme. This insures the house for 10 years. So it means that should there be a problem with the roof or the walls or the windows during those 10 years, somebody else will come and fix that for you. So you don't need to spend that money. That's all covered. And with appliances, so new build houses will generally come with maybe a fridge or a freezer or a washing machine. Those are all insured for 2 years. And again, that just saves you the hassle. If anything goes wrong, you know you've got a warranty in place. Okay. Personally, my favorite thing about buying a new build is really the sense of community. So we deal with a lot of builders up and down the country, and every single new build site that I go and visit, we've got WhatsApp groups going on. They're having family parties, they're having community parties, and you get the real good opportunity to build that community the way you want it to be. So you'll make friends with your neighbours, you're all moving in together, and you're all starting that process at the same time. And it's a really lovely thing to see everyone on the street move in at the same time and get to know each other. So I would really recommend it. I just wanted to finish by giving you some top tips for first-time buyers. So some things that maybe you haven't thought about and maybe you have, but just to make sure you are aware of them. So first thing is build up your credit score. It's really, really important. And that doesn't mean you don't have any CCJs, although don't do that. It also just means really simple things like don't take out any more debt unless you really need to. Don't be getting a mortgage offer and then go and get some finance. So you've got your house, you've had your offer accepted, and then you go and decide I want to buy a sofa on finance. We have had people fall down because of that. So please don't do that. And also make sure you register on the voters roll. So some of you might still be living with parents, you might have just finished university. It's so important for your credit profile that you make sure you're on the voters roll and that you're registered, because it really, really increases your score and means that lenders can find you. So that's a really important thing to do. Next thing to do is to make sure that you're aware of all your costs. So there may well be costs you haven't thought of. So there'll be things like solicitors, stamp duty, reservation fees, surveys, maybe additional costs on top of that for damp and timber reports and all sorts of things that you might need to get done. You need to make sure you speak to a professional advisor, get full advice on that. And what they'll also do is they'll go through your bank statements with you, and they'll make sure that you've budgeted for everything. So if you are a first-time buyer, it might be going through how much is council tax, how much is my food going to be, how much are my energy bills, and somebody will go through that with you and work out actually at the end of each month what can you afford on a mortgage. And that's a really important thing for everybody to be doing. So before you even start looking, I would do a budget planner and work out your budget. And the last thing from me is just to say, make sure you get a decision in principle. So whether you buy new builds or whether you buy through an estate agent or however you purchase your house, you're probably going to need a decision in principle before anybody will let you potentially view or definitely offer on a property. A decision in principle is a credit check that proves to the estate agent or to the builder that you can actually get a mortgage. You're going to need one before they accept any reservation or offer from you. You don't, however, want to get too many. So by that, I mean you probably don't want to get any more than 3. And be aware that they only last 3 months. So after 3 months, you will need to go and get another one. Now, the other thing to make sure you're aware of is that you don't have to use an estate agent's mortgage advisor. Sometimes you will be sort of pressure sold to, and they will say, well, you have to speak to our advisor. You actually don't. So as long as you have a decision in principle, sometimes called an agreement in principle, from a reputable broker or a bank or a building society in the UK, then you are good to go. And the last thing that I just wanted to mention to you was I just really wanted to say, don't go direct to banks unless you need to, because we've just talked about the difference in affordability and how the lenders will look at different ways of calculating your debt or calculating your income, or, you know, looking at the budget and things like that. And it's really important you go to what's called a whole of market broker, because they will be able to look at every single lender in the UK, or the majority of them at least, and make sure that you're getting the right lender for you. And where you may have had a no before, it may be that just by going to a different bank or building society, you might actually turn that into a yes and be able to buy a little bit sooner than you thought. So that's it from me. Please speak to a professional mortgage advisor. If you want our information or you want to book an appointment with us, then you do have the QR code here. And Nick's going to make sure you've got all of my contact details as well. Thank you very much.
Thank you, Gemma. That was amazing. I learned so much from that. I really appreciate it. I hope everyone can hear me. I'm Mel Toomey. I work for Halo Housing, and we are a shared ownership specialist. What I want to talk to you about today is our Home Reach offering, which is our brand name for shared ownership. And we've also launched a very new product called Home Reach Flex, which I'll come on to. So these are the two products that I'll be talking to you about this afternoon. So with Home Reach, it's a shared ownership scheme, but what makes us different to other housing associations is that we do partnership deals with the big house builders like Barratt, Linden, Bovis, Taylor Wimpey. And what we do is purchase properties from them that were destined for the open market, but we offer them to you under shared ownership. And what you would do is find out what share you could buy of that home. You would need a minimum deposit of 5% of the share value. And then for the share that you don't purchase, we charge a rent of 2.75%. Very much the same as all shared ownership properties that you've probably seen on the Share to Buy website. We advertise all of our properties with Share to Buy, but I will come on to some of the current schemes we have available. The most important thing to tell you about shared ownership is it gives you an option to purchase the home that you need and want, but to buy the share that you can comfortably afford today, and also give you a buffer as well, so that if interest rates do go up or go down, you actually can adjust your affordability to meet the requirements of those repayments without putting your home at risk. Shared ownership is a really good way of purchasing the home that you want and love, and maybe buying more shares in the future. The rent that's currently charged on the unsold part of the home is actually less than interest rates. So what we're finding is shared ownership in this current market has become very popular. As Gemma mentioned before, Help to Buy going has meant that those Help to Buy purchasers have moved into the shared ownership market. And what we're finding is there's still a huge demand for shared ownership homes, but there's not enough around to meet what your requirements are. Here at Home Reach, we have a lot of houses. In fact, 80% of what we sell are houses and 20% are flats. And I'll show you a few of those in a moment. But the really important thing to tell you about is that our homes are not built by Halo. They're actually built by Barratt, and you therefore, or Bovis or Vistry, and you therefore benefit from all the private spec that you would expect on a new build home. So, you know, beautiful kitchens and gardens, but you can see some of those on our website. So what's the criteria for purchasing shared ownership? Well, you've probably heard this time and time again, but I'll quickly just run through the eligibility criteria. Government set the eligibility for shared ownership. They fund shared ownership homes throughout the country with all housing associations, and there are income caps. So the maximum income for properties outside of London are 80,000 per year, and inside London 90,000 a year. You can be a current homeowner to qualify for shared ownership, but you need to be selling that home in order to purchase the shared ownership home. Often we are helping people that currently live in 1 or 2 bedroom apartments and can't afford to move to the next stage up the ladder to maybe a 2 or 3 bedroom house. And they need those properties because they've now got children and family or pets. And therefore, shared ownership is a really good solution for being able to move up the ladder. So please be aware, shared ownership is not just for first-time buyers. But if you own a home, you must be selling it in order to purchase the shared ownership one. It's an opportunity, obviously, to buy a home if you can't afford to buy outright. But you can, of course, purchase further shares in that home at a later date. And what we see is people will buy, say, 50% of a home today, and then when their mortgage term has finished, the criteria also, you need to make sure that you have a good credit history. And Gemma did speak earlier about keeping an eye on your credit score and understanding about your debt, because the more debt that you have, the less borrowing power you have. So it's really important to maintain a good credit score and keep your debts low when you first want to enter into home ownership. But as Gemma already said, it's really important to speak to an independent financial advisor and get a real clear understanding of what properties you can afford, in what areas, so that you can look and not be disappointed because you can't afford it. So how can you find a HomeReach home? Nick will provide some links to our websites later on in the presentation, but I just wanted to show you a few highlights from our websites. So we cover the whole of the country, so you can find a HomeReach property anywhere in the country, and that could be a new property that's come for sale, or it could be something that we sold a couple of years ago and now someone's selling it on. But you will find that we cover the whole of the country. We have a selection of properties always on our website, so you can also find them on the Share to Buy website. So every property that comes into marketing that's a HomeReach home always goes on the Share to Buy website. So currently we have in the London and South East, we've got Dover Court, which is an apartment block, but we also have some properties in Feltham, which is just in the southwest of London, and we also have some properties coming up in Streatham, but they're not in the market. But you can see where I'm going with this. Every week we are releasing new properties to the market, so it's really important to log on to either HomeReach or Share to Buy every week and just check what's available. We've got some apartments in Milton Keynes, and you can see here some price differentials just to give you an idea of what's available. Some in Aldershot, which is a commuter belt into London, but properties are obviously a lot cheaper just outside London than they are inside London. In the North and Midlands, we have a lot of properties, and I mentioned these today. Not everyone is looking for properties in the North, but if you are looking to relocate, you will find that we've got a lot of houses in the area. And the majority of our properties are in fact 3 bedrooms. Sorry, my clicker won't click. So these are actually Barratt homes. So we have bought these homes and converted them into shared ownership. And so these are houses that were destined for the open market. They come come with all of the spec that you would hope to buy in a new property, fully equipped kitchens, washing machines, fridge, freezers, as well as built-in storage and wardrobes. So they're what's termed as turnkey. That means you turn up with your sofa and your bed and you're ready to live in your new home. We've also got some in Whitley Bay. Again, I just wanted to show you a selection of the different types of properties that are available for shared ownership, but there's far more on the Help to Buy, Share to Buy website. Right, this is a new scheme that we've introduced called Home Reach Flex that I wanted to tell you about. We at Halo have recognised that shared ownership does actually ostracize some people because of the income caps. And we've noticed that often people's incomes are above 80,000 a year outside of London, and they can't actually access shared ownership. Or during the course of this year, they may be getting a pay rise that means that they're no longer eligible for the government shared ownership scheme. So what we have done is developed a product that doesn't require government grant and therefore doesn't have to follow all of the rules required for shared ownership. The main rule being that you must have an income below 80,000. For Flex, the income is actually 100k. You do buy larger shares of this scheme, because we're really trying to target the market that was using the Help to Buy equity loan scheme. But the big selling point for us and why the scheme is becoming so popular is because it doesn't have the income caps with standard shared ownership. There's no nomination agreement. Now, you might not know what that means, but when it comes to selling your shared ownership home, you have to go back to the landlord to establish the current market value. And you still have to do that with Flex, except we just let you go and sell your property directly on the open market with an estate agent. All of the other benefits of shared ownership are the same with Flex. You can decorate your home, you can keep a pet. We have no restrictions there. I do believe we're going to play a little video on this. So Nick, if I can get you to play the video, that would be great.
Looks like the video might just be coincidence.
Okay. Thank you. So how does the shared ownership Flex work? Well, I don't know where my slides are. There they are. What I wanted to show you here is what it looks like to purchase a home on the open market and what it looks like to buy maybe a 65% share of that home or a 75% share. So the far right house shape is showing you the monthly outgoings you would expect if you paid for 100% of that property with a 10% deposit. So that's 1,555 as the interest rates are today. Now, if you move to the middle and to the right, you can see that there are a few hundred less per month if you buy a share, because the rent on the unsold is less than the interest rate. And that is really the crux of why shared ownership and why Flex works so well for those people wishing to be a little bit more sensible about how much mortgage they take on and ensuring that they're affordable today and in the future. So where can you buy a flex home? Well, as I mentioned, it is a new product. So at the moment, we only have a few schemes in marketing. However, I have agreed several deals with different house builders where I'm buying properties that they were selling on the open market and I'm turning them into properties for shared ownership. So we currently have some homes in Devon, and these are three bedroom houses. Sorry, I keep having problems with my flicker. So you can see these beautiful homes set in the lovely area near Dartmoor National Park. 3 bedrooms with 2 bathrooms and a WC, garage and parking. I mean, who can buy those on shared ownership? And these are the exciting things that I like to show people. We've also got some in Nottingham, but we do have some coming up in Oxfordshire, Cambridgeshire, and in Kent as well. And those will go onto the market within the next couple of weeks. So again, please check Share to Buy website and our HomeReach website. But you can also download some brochures as well, which will be attached to the end of this presentation if they're not already in the chat room. For everyone on the webinar, we're also offering a special offer for you guys, which you can take advantage of. If you reserve any HomeReach property and you mention the webinar, you will get a £500 John Lewis voucher at completion. So just remember to mention the webinar. You can't do it retrospectively. You must do it before you reserve. I'm going to hand back to Nick now to speak to you all and get your questions. But thank you so much for your time.
Thank you very much, Mel. Hopefully you can hear me. Just give me a thumbs up if you can, please. Yeah, yep. Good. Thank you very much, and welcome back, Gemma. So yeah, thanks very much. There was lots of brilliant information there, and we've had over 200 people join us live for the webinar. So I'm sure lots of people have taken away lots of great information there. We have,
oh dear.
I think Nick's just having some technical difficulties.
He is. I'm back.
Questions come in. So bear with me. Also, thanks to anybody on my side of things. There was potentially a couple of technical issues going on. I don't know if I missed anything after question we have I frozen, or are you with me? Can you guys hear me okay?
Again, Nick.
Yeah. Okay. Can you hear me now?
Yes.
Yes, no?
Yes.
Yes. Okay, cool. Yeah, bear with us. So apologies. There's some sort of technical issues on my side of things, I think, today. But yeah, so we've had lots of questions. I'm going to start with some nice, easy ones for you, and then we'll get into the more tricky ones. So can I have pets? And if so, is there a limit to the number of pets that you can have in a HomeReach property? And do you have to get permission to have pets in those properties? So I guess that's one for Mel, I think.
One for me. Sorry, I was reading some of the questions. One that I just want to address a question that was brought by one of the buyers before I answer that was that
sure.
The government changed the income caps. They haven't. The government caps still remain. They will not change them. What's happened is we have created a private shared ownership scheme called Flex, where we have increased the income caps. And the reason we've done that is we found there are a lot of people who can't afford to buy on the open market and can't access shared ownership because they live near or around London and their incomes deemed are too affordable. So that is why we're doing it. It's only private. So it's really important to remember government haven't changed the income caps. But in terms of keeping pets, was that the question, Nick?
That was the question, yeah.
Yeah. So a lot, a lot of flatted properties have rules about keeping pets. And sometimes it's not Home Reach rule that you can't keep a pet. It might be the freeholder of the block. So we often have to go back to them and say, is it okay if one of our purchasers keeps a pet? And they give us the decision. With houses, you don't need to ask that question. You're allowed to have pets. But sometimes just with flats, you have to just ask the freeholder. Okay, should we just, Gemma, nick another question?
I think I saw some questions around, can you get a mortgage if you just have benefit income? And I think there was also a similar question around visas and how long you needed to be in the UK for. So yes, absolutely. In both those situations, you're going to be able to buy. You're going to be able to buy a shared ownership home. The only thing you're going to have is maybe slightly less lenders available to you, and you might need to put a larger deposit. But again, I'm going to say this the whole way through. Speak to an advisor and see what suits your individual circumstance.
Yeah, absolutely.
I've seen. Can you still hear me?
Yeah, we can now. Okay. Yeah,
I've turned my camera off just in case it's affected anything. But yeah, don't worry, ladies. I've got lots of questions to ask you. So, if there's anything you've spotted, do you want to go ahead and answer first, or if you're happy for me to just go through and pick some out? But yeah, so we've had a few questions from some of the audience members that are in their 60s or late 60s, early 70s, and they're just curious about whether, probably one for you, Gemma, whether it's actually possible to get a mortgage when you're in that stage of your life.
Yeah, absolutely. You're going to need to have pension income or some form of income to prove you can afford the mortgage, and you're probably going to be looking at a slightly more specialist lender, but most lenders now will go up to age 75 with no problems, and some of them will go up to potentially up to age 90. As long as we've got pension income to prove it.
Okay, thank you very much. And Mel, you did touch on this earlier in the presentation, but we've had a couple of questions about it. You mentioned that the Home Reach properties tend to be delivered by the private developers, so the likes of Barratt and Vistry, you mentioned, and a couple of others. So one of the questions we had was, is there a loss of quality when you have a shared ownership property? Are there inferior properties to those that are on the private market?
No, they're in fact they are the private market properties. So what's happened? It's almost like buying a car. That's my best analogy. You go to the showroom, you decide that you want that car, and then you decide how you're going to buy that car. Are you going to pay for it with a loan, or are you going to pay for it with an interest-only loan? Or shared ownership, but the car is still the same, and no one actually knows how you've paid for your car. And that's exactly what we are doing with these properties. So it's house builders are building these homes for the open market. We go into partnership with them. They get the money that the house builder needs for that property. We resell it as a shared ownership unit to you, but the house builder is dealing with you in terms of the viewings and reservations. I've spotted a couple of others. People have asked, can you buy with cash? Yes, you can. That's not a problem. You don't have to be a mortgage provider, a mortgage buyer, but there are some checks that need to happen. There's no ageism with shared ownership or mortgages, to be honest, but I'll let Gemma answer on that. Someone's asked, what happens if you're earning over 100K? Can you use the flex scheme? The answer is I don't know. It depends. If you can afford that property 100%, then you wouldn't really need the scheme, but certainly worth that person contacting me directly if they wanted to have a bigger discussion. That's it.
Thanks, Mel. And again, sorry if I keep dropping in and out. I'm not going to attempt to blur my screen in the background anymore. So if you're wondering why I've got boxes, it's because I actually live in a shared ownership property and I'm about to move. So I can definitely recommend shared ownership. It's been great for me, but that's why slightly the background of my house is a little bit messy at the moment, just in case anybody was judging me out there in the audience. So thank you very much. So some more questions. So Mel, I mean, you talked about, it being a bit like having a car, and just like having a car, you can add your own personality to your car. With shared ownership, do you have the freedom to decorate, to hang pictures, to put up wallpaper, etc., etc.?
Yeah. Yeah, absolutely. So I've been doing shared ownership for nearly 30 years, and there is a clause in the lease that says you must ask the landlord for permission to do construction that are constructive or adding an extension. And I have had people write to me and say, can I put some shelves up? Look, you're free to do that without any landlord approval. The only time you really need to ask for landlord approval for improvements is when you're building, if you've got a house and you're adding an extension, or you want to put a summer house. And this works both ways in your advantage. You want to make sure you're getting the right building regs and planning, and we want to make sure, because we want to protect the asset. But also when it comes to selling your home or staircasing, if you've added, let's say, a conservatory, you need to make sure that your property is valued, that it includes the improvement if you're selling it, and doesn't include the improvement value if you're staircasing. Because if you were staircasing and the value's gone up because of the addition you've added, you're going to pay for it twice. So it's really important landlord knows about construction improvements as well, if that makes sense. But yes, you live in the home as any normal homeowner.
Yeah, and you can paint the walls orange behind you if that's your
you can.
To you, right? Yeah,
yeah.
You don't have to, but you can. So thank you very much for that one, Mel. I just want to say to the people who are submitting questions, if you're going to put in specific financial information, it's probably not the right forum for us to try and answer those questions for you if it's about your own personal circumstances. But Gemma's details are in the handout section, so if you've got any questions, feel free to get in touch with
absolutely. I've got a room full of advisors willing to help
through that.
Yeah, I would say, so the questions that I've seen so far, so I've seen a mixture of obviously some relating to income, some relating to rent and that kind of thing. I haven't seen a question that I don't think we would be able to help with yet, is what I would say. Oh, Nick, have you gone again?
Yeah, I think he's frozen. We're going to look through the questions. Yeah, there's quite a few for you, Gemma, so I'm going to hand over to you.
Yeah, so there's a couple of people talking about their rental cost at the moment and not being able to afford as much on the mortgage. I think that's a really valid thing. What I would say is actually there's a lender at the moment that's just come out, and they are taking that really seriously. And what they're actually doing is they're looking at, if you've paid rent on that property, and they want a 2-year history if you haven't paid the rent and the bills and you can afford it, then actually they will just go off the rent, and they'll say, actually, do you know what, we agree, and they'll actually lend you 100%. So if they can prove that you couldn't have saved deposit because you're spending all your money on your rent and your bills, which a lot of people are at the moment, and actually because of that you haven't been able to afford a deposit, they will actually let you have 100% mortgage. And we're finding that's working really well for some people, especially if you're in an area where maybe the rents are quite high, and maybe if there's 2 households coming together as well. It's a good option to have. There's also been some questions about CCJs and defaults. Absolutely fine. It's going to depend on credit score as to where we can place you. And with some of the shared ownership companies, they're not going to like it as much. They're going to want you to have a good credit score, but there's always going to be an option available for you. And it's just a matter of finding the right mortgage and the right house. What I would say is you are obviously going to pay a little bit more potentially if you have got bad credit. I've also just seen somebody asking, oh, I don't know where it's gone. No, never mind. The question's gone. I just had one that I was reading, but we'll go back. Nikki, you back? Oh.
Someone's asked a question about, are all shared ownership leased homes? The way shared ownership works, because there are 2 entities, you've got you owning a share and the landlord or the housing association, you have to issue a lease. Regardless of whether it's a house or a flat, there is a lease arrangement. But that lease is 999 years now, so that's a good thing. If you choose to staircase and you buy it 100%, the lease falls away and you get the freehold, or your lender holds on to the freehold until you finish paying the mortgage. But not only does the lease fall away, the rent falls away and all those obligations within that lease. So it's only leasehold whilst it's shared ownership.
Okay. Somebody just asked as well about, do I need to know how much I want to borrow before I get a decision in principle? And I think something really important is no. So what should happen if you go and see a good reputable advisor is that they should sit you down, go through a budget planner, they'll do affordability calculators with different lenders, and look at the monthly cost of that, because it's not just about how much you can borrow, but it's how much you actually are comfortable borrowing. And based on that, you might say, do you know what, actually, I think I can afford, I've gone through everything and I think I can afford £800 a month, for example, for my mortgage. And they will work out how much you can borrow based on that. And you'll get a decision in principle for the right amount. So absolutely not. I would say do not find a house before you get a decision in principle. I think really your first step needs to be to get that decision in principle in place and then work backwards from there.
Thanks, Gemma. Can you guys hear me again?
Yes, we can.
Okay, thank you. You're doing an amazing job of filling in for me, so thank you very much. You're making it a lot less stressful for me that things aren't working. I think my broadband provider might have cut me off just before we're about to move, so but maybe they've done it a few days too early. So thank you very much for that. We've had a question about bad credit. We've had a few questions about bad credit in the chat, Gemma. And if somebody does have bad credit, what's your sort of top tips for turning it around, and how long does it take for somebody who's had bad credit to get back in the sort of clear credit side of things?
Yeah, of course. It completely depends on how bad we're talking. So some lenders now, because it's so common that people get CCJs for things like parking tickets, and certain telephone providers are known for not always ending contracts when they should, and then it turns into mispayments and things like that. So it can be ignored completely, depending on what it is. It also depends on the amounts. So, it could be as little as just make sure it's paid off, or 3 months, or if it's more serious adverse, then we could be talking a few years, but that's more bankruptcy and things like that. So again, I think it's worth just talking to someone, and it also will depend on whether it's already paid off or if you're going to be able to pay it off before the mortgage as well. So just make sure you take professional advice. But there are definitely a lot of lenders out there that cater to this, and with everything going on, obviously we are seeing more and more people who maybe have just missed a couple of payments here and there, while they were getting things straight with the cost of living.
I think he's frozen on us again. No, he's back. He moved. I've just seen someone's said, do you have to be a resident in the borough to apply for shared ownership? The simple answer, I'm going to say no, because the criteria for qualifying for shared ownership lightened up a bit over the years. There are a few schemes in more rural areas where they want you to house people with local connection, but actually generally you should be able to apply for a scheme, because normally you're crossing a borough because of work, family, all sorts of reasons. And certainly in London, it's supported that you cross boroughs. And then outside of London, with Home Reach, our schemes aren't borough specific or district specific, so anyone can apply for them, except if it's a Section 106 scheme. This is where a planning rule has been placed on the development that you must advertise to local people first, and then you can cascade out. Once you've exhausted that small pool, you can cascade out. So anyone worried about not being able to move from borough to borough, you shouldn't have that problem. And I'll be really surprised if you are coming across that problem.
Yeah, I would agree. Yeah. I've just seen somebody's asking about self-employed as well. Self-employed mortgages, absolutely fine. You're going to need to either have, normally you're going to need to have 2 years accounts showing a growth in profit each year. Some lenders will average out, or if it's a good business that's been going for a while, they might use latest year's accounts as well if they're significantly good. And also people tend to worry a little bit about COVID with self-employed. Obviously things like beauticians and restaurants and things were affected. A lot of lenders are aware of that, and they'll take years before COVID and the years after COVID, so that they are aware that those years probably aren't really reflective. So again, same thing I'm going to say all the way through this is just speak to a proper advisor, and they'll be able to find the right lender for your situation.
Thank you very much. I'm going to quickly get a question in before I freeze again. Mel, the rent that's charged on a shared ownership property, is that capped? Does Can that rise sort of incrementally on a yearly basis?
Good question. So the rent does go up every April. It is determined how it goes up in the lease. So currently the rent increase is RPI plus 0.5%. That's what's written in the lease. So every year the rent can only go up by RPI plus 0.5%. We can't, as a landlord, decide, do you know what, I'm going to put the rents up by 10%. We can't. We have to follow that. However, I sound like Martin Lewis here, don't I? Last year, inflation was ridiculous, as we all know. And what that did to rents meant that rents went up by 13%. But the government, quite rightly, and all housing associations capped them at 7%. On average, that meant most people's rents went up between £20 and £30 last year. And it was capped to sort of average of £15. As we're starting to see inflation go down, Gemma mentioned it's at 6.8 now. We're now start to see rents increase with inflation, which will feel a lot better. But yeah, this year's been really tough, and hopefully that's gone away. But as I say, the main thing to remember is the rent is RPI plus 0.5%. You can't deviate from that.
Yeah, thank you very much.
Somebody's just asked about how they work out and calculate the share they can afford. Again, a mortgage advisor will do that for you. So they'll work out what you can afford, and they'll work out how much of a share is affordable for you. Okay. Exactly.
There was a couple of questions I noticed because someone asked, can you buy flex anywhere? Unfortunately, it is scheme specific. We do, however, have a completely separate scheme that I wasn't supposed to talk about. So I would ask you to go to the Halo website. That we have a scheme called Your Home, which is where you can buy a property anywhere, and then we help you convert it into shared ownership. Someone asked about hold as well. We don't do hold. Hold is a government scheme for people with long-term disabilities. There are a number of RPs that do that. If you go onto the government.uk website, you'll find all the providers for hold. And I'm really sorry that I'm not able to help you on that particular scheme, but thanks for asking the question.
Like 4 minutes of time, and then I have to wind back up the Wi-Fi again. So again, I'll try and get in a question while I'm with you. We've had a question about the home flex property or home reach properties as well. Home reach flex properties, Mel, which is, are they freehold properties? Are they leasehold properties that can become freehold properties?
Yeah. So any house will be bought by us as freehold. We offer it to you on a shared ownership lease. And as I mentioned earlier, if you staircase, that means buy it all to 100%, the shared ownership lease falls away and the freehold reverts to you or your lender, not to us. So once you staircase 100%, the freehold goes to you on houses. Obviously with flats, they're always leasehold. So there'll be almost two leases. There'll be the freeholder's lease and the shared ownership lease. You staircase to 100%, you're a direct leaseholder with the freeholder. The shared ownership lease falls away. I hope that helps, that question.
Yeah, because we've had a few questions about, you know, does the rent go up when you own more shares, etc., etc. I think it's worth just kind of pointing out that if you do staircase all the way to 100%, you're no longer a shared owner. In that case, you're a private owner, just in the traditional sense. You don't have to staircase, but if you wish to and you can afford to, then that is your pathway to potentially owning the property outright as well. I reckon we've got a couple more questions, so I'll try and time for another couple more questions. So I'll try and get another one in just before. I think we did potentially, Mel, lose a little bit of the information about eligibility. So I wanted to just maybe give us the very quick highlights on shared ownership eligibility again.
Yes, right. So shared ownership eligibility is about your income, having a good credit. So your income can't be above 80,000 outside of London, 90,000 inside London. You can't own a home and try and buy shared ownership. It's got to be your only principal home. You do not have to be a first-time buyer. If you do currently own a home, like Nick here, who's selling his shared ownership home, and he's selling that to buy on the open market, you can do that. Or you could be selling your home to buy a shared ownership market in order to move up the ladder. As long as you're selling that home, that's fine. You do need a good credit history. This is what the government website says. So we are looking for people with good credit history. There are some adverse or some historic credit history problems that people have, but that doesn't mean you're excluded. So always speak to your financial advisor, or get in touch with Gemma and her team, who are experts in shared ownership. You can get financial advice from anyone you like, but often they don't understand shared ownership and the affordability and how the rent works against your affordability.
Yeah, I mean, we don't, at Shared to Buy, we'd always recommend that people speak to a financial advisor, a specialist financial advisor that's worked in shared ownership, because exactly that, Mel, they'll know the ins and outs much better than potentially a sort of mainstream mortgage broker would. Okay, I reckon we can probably try and fit one more in. Let me see if I can pick a nice juicy one out for you. Is there a specific reason why a decision in principle or a mortgage offer in principle would only be valid for 1 month? We had a DIP that expired after a month, so we had to start again and get a new one.
No specific reason. They are lender specific. So like I said before, most of them normally last for 3 months or 90 days. However, it could be 1 month, some of them are 6 months. It just depends how long the individual lender is willing. It's basically like them saying, okay, we've done a check on you. It's the bank saying, we've done a check on you. And as long as everything you've told us is true, we're happy to lend you money. So they're kind of making you a little bit of a promise. And I think the ones that are shorter, sometimes their concern is, well, actually, what might change in the last 30 years? Have you, like we talked about, gone and got more credit? Have you gone and bought a sofa? Have you done X, Y, Z? So they just want to make sure that you haven't done those things and that actually you are still someone suitable for a mortgage. So it wouldn't be anything to worry about, but maybe look at a different bank where they might last a little bit longer.
Amazing. Thank you very much. So I think we'll call it to an end to things now, just approaching the hour mark. More information is available in the handout section, so please make sure that you download those before we finish. Again, you've got Gemma's details in there, and she says she's got a team of people that's ready to speak to you. We've got information about Home Reach and Home Reach Flex, and also, as you can see on the screen now, is the websites of Home Reach Flex. Mel, is that the right email address, website address for Home Reach Flex? Is it? Yeah. Okay. Good. Yeah. Acumen Mortgages and Shared to Buy. So thank you very much to Mel and Gemma for not only your presenting skills, but your emergency chairing skills as well. Massively appreciate it. Thank you. Thanks everybody who's watched and stuck with it through any of the potential technical issues. I think they were just on my side rather than for everybody. So thank you very much. We couldn't answer everybody's question, but what we will do is we'll share the questions that we've received with Gemma and Mel as well. And hopefully we'll do a job of addressing the most frequently asked questions. So thank you very much, everybody. Enjoy the rest of your day, and yeah, keep an eye on the Shared to Buy website for the next time we have one of our webinars.
Yeah, thanks for joining, everyone, and thanks for all the questions.
Thank you.
Thank you.
Bye.
Bye.